Now for a very nice discussion on where the markets are headed, ladies and gentlemen, at these record highs. Where should you be putting in money? How should capital allocation work? We'll be joined by Devina Mehra, founder and CMD at First Global. She's a very well-known stock picker, runs an amazing PMS at First Global, and is one of the finest exponents of long-term capital appreciation as also wealth creation. Namaste Devina ji, what a pleasure to host you. It's buoyancy all around, difficult to find a pain point in the market, record highs everywhere, and from the smile that you light up our screen with, I can imagine that all unit holders of First Global's PMS are very happy people. Welcome and good morning.
Namaste, Shell. Good to be here. And yes, I mean, I have probably been a little more cautious than most other voices, but the market really has blown out the lights. I mean, June alone, depending on which index you look at, it's between 5.5% to 7% up, which is amazing in a little less than a month. So that's been quite spectacular. But as I have been saying in my interviews, even prior to the election, actually from March onwards, we had been hedged. So we did have some apprehensions that there could be an interim correction, which did happen to some extent in March, some extent, after the election, but that was very, very short-lived. So you can say that we bought insurance, but just as in health insurance, you don't say that insurance was a waste just because you were not hospitalized that year. It's something like that here. But as I had also repeatedly said, we did not make a cash call. We did not go into cash. So we were always fully invested, but we were hedged. We are still partly hedged because the market has, as I said, gone up very, very fast. So that's where we are, and it's been a good place because most times, unless you are anticipating almost for sure that a crash is coming, it makes sense to remain invested, and you can always hedge. The parts which you can't hedge are the small cap, micro cap, because there neither does buying a Nifty put work as a hedge, nor can you really have proper stop losses, because when those stocks fall, they go so fast, there is no exit. So in our PMS, for example, for stocks below 5,000 crore market cap, we normally have something like 14-15% of our portfolios there. We've gone as high as 20, but currently we are only at about 7% or so. So we know we are being very conservative, giving up on some of the momentum side, but we always err on the side of risk management and caution.
Absolutely. Devina, before we take this discussion forward, let's look at the one-year rolling return. The Sensex is up 25% over a one-year basis. The two PMS schemes that you manage, what are the returns on a one-year basis in both of them?
I'll have to check the exact number. At the financial year end, I remember we were at close to 40%, about 39%. This month alone, we've got, along with the index itself, we are up, I think, 5.5-6%. So I'll have to check exactly where we are on a one-year basis. In any case, SEBI doesn't allow you to talk the exact numbers till the month is done and all the charges or expenses are put. So that's normally 10 days after the month is over that you can talk the exact numbers.
No issue. I have a fair idea of your outperformance, and I'm sure it continues. Now, talking about risk and hedge, one of those lovely things that markets have taught us is that the correction does not send a telegram or does not send a mail ahead in advance, and it happens when you wake up next day morning. Markets are already down 4-5%. So hedges work, risk works, and that is what fund managers and wealth creators such as yours are actually paid for. Now let's look a little ahead. It's become very easy to make money in the morning or late afternoon at 3:15 p.m. Pick up any defense stock and wait for 2-3 days. 10-12-15% बन जाता है, and it is a affliction that is across the market. Now tell us, one, what is driving it, and when will this party come to a halt?
So it's always difficult to say what is driving it, because I think we just look for stories to fit what is happening. So there's a good book called Everything is Obvious Once You Know the Answer. So the very same set of circumstances in hindsight can be used to justify a rise in the market or a fall in the market. So, that's all. So, I mean, it goes up till it goes up. And the only thing, of course, what gives me a little bit of comfort, not on a 1 to 3 month basis necessarily, but on a longer term basis, is that the market is still not, if you look at returns, while that 1 year return is very good and all that, if you look at longer term, we are not at a great highs. And this is the data I think I would have given earlier also on your channel, that if you look at that whole decade from 2010 to 20, if you had put in 100 rupees, it would have become only 230 rupees, barely higher than fixed deposit returns. And contrast that with 1980, if you had put in 100 rupees, you would have 700 rupees at the end of the year. So that whole decade of underperformance, that 2010 to 20, is what is allowing this bull market to run. And as I said, you are still not at the trend line. The real risk is when you are far above the trend line. So that we are not there yet. So that's why on a 1 to 3 year basis, I don't see great risks. But I mean, as I said, there are frothy areas of the market. There's small cap, micro cap. There are all these things where stories are being built up. Even when you look at somebody getting an order, you go to the past and you will see that every project has a time overrun, a cost overrun many times. It's a winner's curse that somebody who gets a big order actually ends up in a mess. So I think some of these things are becoming a bit too much of storytelling and hyping, and whenever, in whichever area of the market, as you said, money making looks so easy that anybody can do it. That's where the dangers are.
Absolutely. And these are the time, ladies and gentlemen, when you have to be extremely cautious. When all stories work out, that's the time to pause. That's the time to reflect. That's the time to build a hedge, even if you're not moving into cash in your portfolio. Devina ji, upon us is the national event that the entire market waits for with bated breath, which is the national budget. Now, wear your thinking hat and tell us what and where is the government likely to act upon which might benefit capital markets, and 1 or 2 points where you think the government will take away something.
I don't know what the government or the finance minister will do. I mean, that would be purely speculative. And the budget, I think we make it into a bigger event than it should be. But in terms of where I think the government's priorities should be, probably, the audience for this talk will not be very happy to hear that, because very little directly to do with the markets. But I think the priorities should be health, education, and employment. These are the 3 areas where the government really needs to focus, and actually health and nutrition, also an education, all these things also eventually translate into having a workforce which is employable and can be employed, and therefore as a second order, it drives consumption, it drives company profits, it drives the economy. But in the short term, for the market people, they call it populist, they call it freebie, they call it giveaways. But ultimately, those are the things that are required for the long-term health of the economy, even the long-term health of corporate India and the market. So, and this has been a tough thing because the pandemic has even derailed education, a lot of things like that. So, and employment, we are in pretty not in a good territory at all. So we have the young workforce, but we're not able to find jobs. So those should be the priorities in to my mind.
Yes, absolutely, Devina. And you know, uh, this is just an aside, nothing to do with markets. I think those people who have absolutely full stomachs and bulging bank accounts are often the ones who crib the most when the government takes care of people below poverty line. Offers education, quality education to a vast majority of the not so fortunate people in India, and of course feeds people. Uh, be that as it
Shall I
may, we
just to
have to
add
live
to
with
that,
that
I read
thought process as well.
Shall just to add to that, I read this book
Please
by Rama
continue.
Vijayapurkar on called Lilliput Land, and that had data
Yes.
on incomes, which was very eye-opening. That the bottom 60% of India, it is not just an increase in inequality; their incomes have actually gone down and have been going down from 2016. And also, the bottom 60% of India has no surplus, meaning income minus routine expenditure is zero to negative, let alone one-time expenditure like marriage or some medical expense. So this is the situation, and which is why even in terms of the economy, you see the consumption growth is very low. So GDP growth has primarily been driven by
Yes.
government expenditure. So we need to get consumption up, which means, as I said, employment up and things like that.
That's a fair point to make, and once you improve the social indicators of any country at the BPL level, the economic indicators automatically take an upturn maybe after 6 months to a year, and perhaps that is a message that's percolated very well in the national elections that were just held. Now, Devina, wear your thinking hat. Tell us where the markets are going to be. Tell us where you still find value, and tell us the crores of rupees that are coming in the first global PMS, where are you deploying them?
Okay, so of course, our allocation remains the same, no matter whether you joined 3 years ago or you're joining today. And right now, we remain overweight on capital goods and industrial machinery. We've been overweight nearly 3 years from October 21 on that sector. Last year and a half, we have been overweight auto components, pharma, bits of construction. So that those also we remain overweight. But I mean, we are watching. We don't know that how much of those stories have already played out and how much is left. So we are watching for a turn. The sector we are watching for a different turn is IT. That sometime this year, I think it will bottom out. In fact, this month also it has done better than the index. The Nifty, if you look at the IT index, has done
Yes.
better than that. So that's probably close to bottoming out. Banks, while we don't intend to be overweight, we are still underweight. But I think the long period of grave underperformance may well be over, and maybe it will be a market performance sector. We remain a little more skewed towards PSU banks than private sector banks. So that would primarily be, but we are quite diversified. So even when we like a sector, we'll never put 40% of the portfolios in that or anything like that. So we
Yes.
do have allocations to a wide variety of sectors.
Fair point. So, PSU banks, let's discuss them. I think it was a great 30-month period on PSU banks, especially the top five, and people made tons of money. When you look at very robust balance sheets, net NPAs and GNPAs at multi-year lows, credit growth in strong teens percentage point, and of course stock prices doing phenomenally well. Is this the peak of the party?
I mean, as I said, in terms of the stock market performance, the PSU banks obviously have done well. The private sector banks not so well. And if you look at a 4-year picture, 2000 20, 21, 22, 23. 2022 is only 1 year when the bank Nifty outperformed the Nifty. So that tells you something that what the reality of the sector is. But yes, I mean, I have concerns on credit quality. I saw data which I haven't quite verified that while debt as a percentage of GDP or something may not look so skewed, but if you look at the debt servicing as a part of household income, that's at a very significant high. I saw data which said that it is as high as it was in the US before the 2008-9 crisis. And also, as I told you, incomes have not been going up for people. So number of these loans have been to finance consumption because you did not have the income, you are using debt to finance consumption. So those are worrisome signs. And as I always say that if banking and lending was not such a big part of the index, I would be happy to ignore it because this is a very risky segment always because negative surprises come more often, and as an outsider you don't know where and when the negative surprises will come, and growth in this sector is not always a positive because lending out money is easy. It's getting back the money when the issues arise. So
Absolutely.
Always a sector to be cautious about.
As a banking analyst, when you start the job, your senior tells you if you owe the bank 5,000 rupees, it's your problem. But if you owe the bank 5,000 crore rupees, then it becomes the bank's problem. Let's hope we don't reach at that level. But yes, credit servicing as a percentage of disposable income is rising, and that's a point of pain which might sort of blow up in our faces. But yes, banking looks pretty good. And our erstwhile favorites, your first research report on HDFC Bank, I'm sure you remember it more than anybody else. The bank is back in focus now, above 1700 rupees. Devina and I go back a long way. We have a lot of stories to swap on the markets, and I'm hoping she's in Delhi. We'll have a nice meal and discuss over them. Devina, where is froth? Where are you staying away completely?
Sorry, I missed this question.
I'm asking, where is froth in the market? Where are you staying away completely?
As I told you, for stocks below 5,000 crore market cap, below 1,000, we don't even look at that. And 1 to 5,000, we normally have about 14-15% of our portfolios there. We've gone as high as 20-22%. Right now, we are at 7%. So you can say that that's an area as a whole. I mean, there will be stocks which will be exceptions, but that's where I see risk. And there are also, I mean, especially, along what happens is that in small caps, there might be a few good companies. I'm not saying they're not, but along with the good companies, a lot of pretty shady companies also start to be touted, and there are, and for a short time, you might even get the returns on them. But when that segment crashes, there is no exit. So people who are new in the market may not remember this, but that's how this part remains. Also, I mean, there are anywhere where there is too much hype, you have to be careful, including, I mean, IPOs or fundraisers. I see now, I mean, this is again a sign for me when people start to talk about a fundraise as being a positive for the company. And that normally is not a good sign at all, because an equity fundraise dilutes equity, dilutes return ratios. And when people start saying that, oh, this company is doing a QIP, a qualified institutional placement, or a public offer, all that usually signifies that at least for that segment, the market is topping out. And if you see even 1 year returns for Nifty versus broader indices, there is now a reasonable gap.
Absolutely. That's a very well made point, and also my next question. Devina, it becomes impossible to track the number of block deals that are happening, and in 7 out of 10 cases, it's the promoters who are liquidating at what is now a record level. We don't know what it will be 3 months, 1 year later. But the sensible and the practical ones who see money available on a platter are diluting their stake. Being a very long-term watcher of the market, how do you see this? Will it derail the bull run, or will it add to liquidity and maturity of the market in the secondary space?
Well, in theory, you will say that it adds to the liquidity, but and also in theory, the promoter should diversify their own investments or their own net worth. So I do not always see that every block deal or every sale by a promoter, whether here or elsewhere in the world, as a negative. But when it becomes a pattern, when too many promoters are doing this, it shows, at least in their mind, they know what is the future of the business. And while, again, as a one-off manager, promoters may not be always a great judge of what the value of their stock should be. But, again, as a pattern, if many are doing it, it shows that at least they think the stock is overvalued. So that's definitely, all these are just signs, and all put together is what gives you caution on certain segments of the market.
Fair point. Devina, it's no longer a pattern, it's a collage. I maintain a list of blocks that are done, on a daily basis, because it's our job as market observers to track them. Yeah. But 65,000 crores so far year to date, and the drum beats of promoters' footsteps partially exiting the Lal Street get louder and louder. Nevertheless, this is what markets are, and this is how markets behave. It's all good news for mutual fund managers and PMS managers that you get liquidity at a certain price, and these are elevated levels. Let us enjoy the bull market as long as it lasts. But what about IPOs? What about the SM? Yeah, tell me.
Yeah, I said, and also remember that the small cap index crashed nearly 80% in 2008-9, came back to those levels after 8 years, and which was actually a totally different index. The stocks that fell never came back. And then there was another mad bull run for 1.5 to 2 years, and then there was another 2/3 crash. So, for the newbies in the market, those are numbers to remember. And when things fall, everything falls. In 2008-9, how many of the small caps didn't fall? 1%. In 2018-19, how many did not fall? 8%. So you are not this genius who will be in only those 1%. So please remember that. So, I'm sure many of you would have made a lot of money in that end of the market. Now is the time to book those profits and put it in steadier stocks.
Right. Devina, nobody wants to listen to caution. At parties, at dinner parties, at weekly meetings, professional and personal friends are not interested. उन्हें नहीं सुनना रिस्क क्या होता है, उन्हें नहीं सुनना क्या हुआ 2008 में, 2015 में, उन्हें सुनना ही नहीं है. But like I said, these are characteristics of a trending bull market, and we have to accept them even if we don't agree with them. My final question to you, because you are a global fund manager and you can put it in the right perspective, India's addition in the JP Morgan bond index starting today, how do you see that changing the landscape of Indian borrowers over 2-3 years, how we manage our forex, and how does it sort of complicate or improve RBI's functioning?
Yeah, RBI will have to be more careful, and I think RBI normally is anyway a fairly cautious regulator. So I'm sure they will manage the foreign bond raises by companies, and but only thing, of course, what happens is that India is a capital deprived economy. So any window that opens us, as we are seeing even in the domestic market in IPOs or follow-on offerings and so on, that there's always a crowd at the door. I remember, whatever, almost 30 years ago when the GDR, the Global Depository Receipts market opened up, and Indian companies started to raise money overseas. This was equity money, but I thought it would be a big market. But when we looked at the data, we found Indian companies were 90% of the GDR market. So that's what happens at any thing that opens up. There's a rush for that. But on the debt side, I'm sure RBI will put in enough controls so not to for it not to go out of hand. But companies also sometimes forget the currency part of it and are too attracted by the interest rate number. So I hope, at the corporate level, the managements are also cautious.
Right. Thank you so much, Devina. What a pleasure to have you on Market today. It's been such an exciting 30 minutes of understanding your thought process in this bull market. And of course, the caution that you repeatedly mentioned and the caution that repeatedly will be ignored by the border markets. That's how bull markets are, and that's how we live with them. Should you be in Delhi, you are more than welcome to have a meal with us at our wonderful office. We look forward to hosting you, and as always, learning from you.
Thank you. Thanks for having me.